it's always important, no matter what you're doing in life. I don't care if you're a school teacher, entrepreneur, an athlete, building multiple businesses. It doesn't really matter unless you understand not only what the map looks like for what you're trying to achieve, in other words, where you want to go, but you need to really be honest with yourself and surround yourself with people that are going to be honest with you on where you are on that map currently. Whether you're 25, 35, 45, or 55, and even if you're older, you can't be embarrassed if you're not where you want it to be. And at the end of the day, be receptive and open towards on how to get to where you want to go and what is necessarily needed to be done for you to take those action steps. And I want to introduce my partner, Eddie Gartner. What's up, Eddie?
How's it going, Rob?
Eddie's been here with this journey since we started this epic edification, innovation, rise, this next step in epic, which began at a 3-day immersion with Sean Callaghy back in March of 18, March 1st, 2nd, and 3rd. Since then, we've had a meteoric rise. Today, we're going to talk more about not so much the insurance agent who's looking to get economic redemption and have a job, but to you, the person out there that every day seeks financial education and what that financial education looks like and how to implement it and apply it.
Yeah. So we want to get into today specifically, how to follow the epic financial freedom map that was created. But before getting into that, Rob, maybe just take a moment and talk about what does financial freedom look like for you and maybe what it might look like for some other people, because I think it's different based on where you are.
Great question. And listen, no matter what it looks like for me, that doesn't matter for how it looks for you. But what I can say is the common denominator for financial freedom is really, to be able financially to do what you want, when you want, how you want, with who you want.
Yeah.
Right? So those 4 statements that I just made, if you're a farmer in Nebraska, from a cash flow perspective on a monthly basis can be way different than, a grocery store owner in Queens.
Yeah.
Right? Queens, New York.
Absolutely.
It comes down to the value of money. It comes down to your relationship with money. Do you understand leverage, liquidity, and control? Does that make sense for you? Or do you want everything paid off and at the end of the month your fixed bills are $10,000 and you have $15,000 and that's going to be the way it is for the rest of your life? It all really depends. Great question. Yeah. And you know how we like to get here. We like to get very specific because we never want to speak in general terms. Right? So we want to speak of, okay, if that's the question, then what is the definition? The definition is the same for everybody, except within that definition, how does it apply to you in your private world on what you're looking to achieve?
Yeah. So I think, what you're talking about, having that freedom, for me, I feel that freedom coming through cash flow, right? Yep. And to me, the most important part of financial freedom is actually that time freedom that's created. But let's get into a couple things. And so in developing the financial freedom roadmap, part of it is the education, right? And so when people are looking at the map and trying to figure out the rules of money, can you talk to some of the specific rules that are out there that financial institutions, quote unquote, educate us on every day on how they want us to play the game?
Yeah. So great question. And we do have, if you click the link below, you can see that we have the Epic Financial Freedom Map, which is about a 12-minute video that really kind of provides education on to identify where you are financially and where you want to go and some of the things to think about on how to get there.
Yeah.
But, Eddie just asked me a great question. And once again, this comes down to you every day, all day, twice on Sunday, or being sold something from somebody, whether it's on a commercial, whether it's from your advisor, whether it's from a friend. And he talked about how the financial institutions have built out strategies, language, and concepts for you to live by. For example, you may have heard of term and invested difference, A.L. Williams. I think that was in the 80s. Not that term and invested difference isn't good, but in general terms, what they basically said is do a 401k and put the difference into a term policy.
Yes.
Okay, great. Did everybody know that when they took money out of the 401k, it was going to get taxed at ordinary income, and that at some point their coverage would expire, because that's what happens with term policies. But if you think of the financial institutions, they're going to tell you to do things like dollar cost average. They're going to tell you to put money into something on a monthly basis, on a regular and ongoing basis. They're going to hold it for as long as they can, which is a 401k and an IRA. And then when you retire, they're going to give you the least amount back. Because listen, if you have $1 million 401k, you're not going to cash it in because you're only going to get $700,000. So they're going to say, all right, now you're in retirement, live on the 4% rule. So now you got $1 million in a 401k.
Yep.
You're now getting $40,000 a year, plus Social Security, and I believe that 40 may invoke taxes on your Social Security and may not.
It could.
It depends on what the tax bracket is. But, I think once you get to retirement and you're taking that money out, between federal taxes, state taxes, local taxes, Social Security taxes, Medicare taxes, or Medicare, you may be sixth or seventh in line to get your money out of that 401k. However, when financial institutions spend millions and millions and millions of dollars in advertisement, you're going to be conditioned to do what they say.
Yeah. Think about one of those conditionings, right? Where does everybody put their money today? They sit it in a bank account for the most part, right? Yep. We've been conditioned in a way to hand our money over to the banks and get nothing in return on it. Whereas, I remember looking back, my parents had opened a bank account for me when I was born, and I remember going and making those deposits being young with the passbook, right?
Yep.
And you give them the thing, they run it through, it prints out your balance.
You're probably getting 5 or 7% at that point, but go ahead.
When it was first started, it was a 10% interest rate.
There you go.
By the time I was 18, it was like a 1% interest rate. And today people would kill for a 1% interest rate.
Yes.
But that conditioning over time from these institutions is this is just what you do.
Yeah.
And nobody, for the most part, has been thinking otherwise, right? Should we be doing other things? So it's just something that it's kind of crazy.
Well, to that
how
point,
it gets conditioned. Into us.
But to that point, Ed, if you do nothing,
right?
Well, putting money into a savings account or a 401k is better than doing nothing.
Correct.
Right. So this is where the education is important, though, because at the end of the day, if you have the ability to save on a monthly basis and you're disciplined, just like somebody that eats right, works out, they're disciplined. If that same discipline shows up in your world between you and your wife or you and your significant other or you by yourself, that you do it, then the real question is, what is the education that you possess and what is your investment philosophy that's tied to that? Because, listen, if you're going to put money in a savings account, okay, I think the argument would be for me and Eddie would say, well, put enough in there for an emergency fund. If you and your wife both work, then it's 3 months of fixed income. If there's one income earner, then it's 6 months. But then what are you going to do after that? I think that don't sit on 300, 400, 500 grand in cash. The question is, how are you deploying your money on a monthly basis after that?
Yeah. And the crazy thing now, too, is with the way inflation is, there's people out there telling other folks like you, as soon as you get your paycheck in, go ahead and spend it all, right? Don't keep any cash on hand. I think that's also a little crazy.
Yeah, we don't agree with that either.
No. But it's just funny how that's being talked about. So, some of the other things that we want to talk to is, Rob, you mentioned access, liquidity, and control, right?
Yep.
And when we talk about velocity of money, right, and the idea of how banks institute that and what that means and how people could actually do the same thing in their own life.
So listen, when we talk about the velocity of money multiplier, what happens is, or if we talk about bank on yourself, if anyone read the book on Nelson Nash, he's talking about like put your groceries through your life insurance policy and run every dollar and create the bank that way. We're not saying that.
No.
But for all you IUL geniuses out there that want to pick certain things apart, because the first IUL came out in 1997, 98, and the market's gone up, although your illustrations at best are fugazi, just so we're clear. But with that being said, when we talk about the velocity of money multiplier, let me be clear. Yes, put money in a savings account. If, in fact, the company you work at has a 401k with a match, go up to the match. I'm not a fiduciary, just so we're clear. Get educated on the fees. Understand the different investment choices, right? So I'm not saying put everything in whole life. I'm not saying put everything in IUL. What I am saying, though, is to Eddie's point, how can you mimic the velocity of money multiplier? What is the velocity of money multiplier? And what that is, very simply, if you look at the banks, they take your money, they then loan it out over and over again. So if Eddie gives you, the bank, $100,000, you give Eddie less than 1%. But because the bank then loans the money out for mortgages, for auto payments and credit for auto loans and credit cards, they make on average 20, 30, 40 cents on every dollar that you give them. That's the velocity of money multiplier.
Wow.
How can you do that with your own money? Leverage, liquidity, and control. How do you create leverage, liquidity, and control? You overfund what we like to say, a cash value whole life insurance plan. Okay, the IUL guy is going to say, yeah, but it doesn't earn the same rate of return as it does the S&P. And I'm like, yeah, no, I get that if you want to look at 16 or 21 years or 10 years. But at the end of the day, if you're going to leverage off the IUL, the money you leverage doesn't get credit, doesn't get any credit inside that policy while you're putting the money somewhere else.
Yeah.
Which is why we like whole life. However, what we do like is with certain situations to blend the IUL with the whole life. Yeah. And by the way, all you Kaizen folks that are out there, and you make it seem like it's premium finance and it's real simple, these people can't touch that money for about 20, 25 years.
No, that's absolutely true.
25 years. If you're a consumer about to do a Kaizen premium finance plan that's going to be held in some kind of trust, you can't touch your money for about 20, 25 years.
And that's the challenge that most people
misinformation
have, is they just don't know. Right?
Yeah. And by the way, you out there, Mr. and Mrs. Consumer, I get it. Everybody's telling you something different. Who do you trust? Well, you trust the team that is looking to put all your planners on the same page, accountant, attorney, fiduciary, insurance agent, for the benefit of your thinking.
Yeah.
Sorry.
So one of the things that we're not saying is don't not do something, right? So there's a lot of investment-only advisors, meaning all they do is manage assets.
What does that mean, Ed?
That means that...
by the way, does that person that manage assets, if that person manages 10, 20, 30 million in 401k money,
right,
or IRA money, knowing that money is going to get taxed on later on, do they still charge a fee on the piece that's going to get taxed?
The piece is on the entire asset that's under management.
So what I just said was, if somebody has $1 million IRA,
the
fee is typically $10,000.
Correct.
Right?
Yeah.
Typically 1%. Right? The advisor knows that 30% is going to be lost to taxes.
True.
Shouldn't they charge $7,000? I mean, I don't know.
Maybe that's on them.
I don't know. Right? I'm just asking. And
maybe you as the consumer can talk to them about that, right? So the point is that we're not making recommendations.
No, we're not.
We're providing education.
Yes.
And saying that all these different products exist in the marketplace for a reason. The challenge becomes when people are given these products without any forethought of what their actual goals and objectives are. And so often we...
So you mean like the guy that showed our client the Guardian illustration, and the Guardian illustration had like some kind of bizarre blend to justify the amount of money going in?
Yeah.
Without educating him on the interest rate being off, as well as the ability to look at the money on the way out from an income perspective?
Yeah,
Okay.
and that happens with people that are just held to one product, right? There's in the industry something called like a captured agent, or somebody who has a contract with one company and that's all they sell. Ooh. And it's kind of like,
that sounds
having one tool, your tool is a hammer and every person you find is a nail, right?
Yeah, doesn't it sound like captive? Like
it's gross.
Okay.
Yeah, it's gross. So the idea there is that we're not saying don't do these things. Part of having this financial freedom roadmap, and the part of the way to get to financial freedom, is that diversification. And we're not talking about just in a portfolio, but talking about diversification in and amongst all different asset classes.
Yeah. It's funny you
yeah.
say that, right? Because I think that when you look at that, right, because that sounds really good, diversification within and amongst asset classes.
Yeah.
How do you actually measure that?
Well, how do we measure it?
That's what I'm saying.
So we have a tool, the Epic Wealth Builder, where we can aggregate all of your accounts, whether they're managed with your money manager, at your 401k, at your employer, your different IRAs. All of these things can come together in one place, and you can actually start to measure. And oh, by the way, this is a place where you can also share that information with your accountant, with your estate planning attorney, and all the different people that you have in your life helping you with these money decisions. We can measure that out and say to folks, hey, if you do this, over the long term, this is what it's going to do. This is the impact that it has on your net worth long term.
So anyone out there that's dealing with CFPs or fiduciaries, keep in mind we do have a relationship with a team of fiduciaries that are down the hall. But here's the question you will always want to ask them is, do they or are they willing to work with your accountant, right? Now, I have a client of mine, a doctor, whose accountant called us 2 years ago and said that Dr. So-and-so needs to open up a 401k so him and his wife can get a write-off. We were like, great. How much should we put in for him and his wife? He said like $18,000 each. Great. So it was $36,000 for a person that makes $800,000 a year that he was going to get a write-off. I said, well, and this is why you got to be careful with accountants as well. I said, well, how about we do a pension plan? And he didn't understand it. So after we ran the census numbers on the employees, understanding husband and wife were part of the business, we wound up doing a defined benefit pension plan where the contribution was not $36,000 but $120,000.
Wow.
So the write-off went from, if somebody makes $800,000 and they're putting $36,000 into a 401k, husband and wife, the write-off in that scenario may be, let's just say 35% of whatever that number is, $9,000 or $10,000.
Yeah.
But now we got the write-off on 35% tax bracket on $120,000 contribution, which dollar for dollar was about a $40,000 tax savings.
Yeah.
The point is, an accountant, if you're not careful, is going to just say, buy term invested difference, do a 401k, and never truly think about what could really be done because they're just trying to get a write-off that year. I'm not saying all of them, but a lot of them. Go check out Anthony Murielli. Go check out Dan Geltrude. These are progressive, bigger thinker accountants that understand the value of proper planning.
Yeah. No, I think that's tremendous value because all too often people are told, hey, do a SEP IRA by their accountant or do an IRA or do a 401k because you're going to get a lower tax bill this year. But to your point, what's a $36,000 deduction this year versus $120,000?
And now we're
deduction?
3 years in.
Yeah. And that's a tremendous amount that somebody can bring down their current taxable income, especially if they don't need that income to survive today.
Absolutely.
So it's
as far as the financial freedom map, these folks can go ahead and click that link below.
Of course.
Right?
If you look down in the description box, we have many links. One of them is the Epic Financial Freedom Map. Rob goes through in detail all the different avenues and areas that we just talked about in different detail and kind of maps out with some graphics on how that velocity money multiplier could work in your world, right? So if that's something you're interested in looking at, please go ahead and click that. But also, if you'd like to sit with one of our team members and have a conversation, there's a link in there for a free consultation. Go ahead and click that button, and one of the team members will reach out.
Yeah, and also, Ed, to that point, though, if there's folks out there, if you're out there and you feel like the market is at, for you, I'm not saying it, if you feel the market's at a high right now,
yep,
and you want to kind of, take some of that money and put it into a place where you could lock in.
Yep.
There's also a link below that really digs deep into annuities.
Correct.
I think that is something you could also take a look at as well, because remember, it's not about, don't ever take all your money and put it into an annuity.
No.
But the thought would be, okay, how much of this, of my overall world, can I put into something that's potentially guaranteed?
Yeah. For people that like protection around their principal, don't like losses in the market, those sorts of things, that most people haven't seen much loss in the market lately. So if you're looking for that protection, in the link below, the guaranteed income annuity funnel, go ahead and look at that. If you're looking to take some of the risk in your portfolio off the table, that can be done through annuities. We'll give you the proper education on all the different types that are out there.